Today, we're diving into the labyrinth of economics, where inflation, interest rates, and the global economy intertwine in a complex dance. Strap in as we unravel the recent warnings from JPMorgan's head honcho, Jamie Dimon. We plunge headfirst into a world grappling with persistent global inflationary pressures. Economies worldwide are feeling the squeeze as prices continue to climb, creating a ripple effect that impacts everything from the price of your morning coffee to the cost of doing business. Enter Jamie Dimon, the stalwart captain steering the ship that is JPMorgan Chase. As the longest-serving CEO of a major investment bank, Dimon's insights carry weight, and he's recently been sounding the alarm, warning that U.S. interest rates could potentially skyrocket to 8%. Why the concern? Well, central banks around the globe are flexing their monetary muscles, raising rates in a bid to combat these rising prices. It's a delicate balancing act, as they aim to keep inflation in check without stunting economic growth. Now, you might be thinking, higher interest rates mean higher borrowing costs, right? And yes, you'd be correct. But here's the twist. Despite these increased costs, the U.S. economy remains robust. We're talking low unemployment and continued job growth. It seems the American economic machine isn't easily deterred. But what does this all mean? Well, in a nutshell, we're at a pivotal moment. Amid global uncertainty and financial upheaval, Dimon's words serve as a compass. His insights and predictions, a kind of economic weather forecast, helping us navigate the often foggy landscape of global economics. As we stand on the precipice of economic uncertainty, Dimon's words serve as a beacon, guiding us through the foggy landscape of global economics. Now, let's delve deeper into the ripple effects of this inflation war and how it could shake up the markets. Imagine standing at the edge of a serene pond, tossing a pebble into the calm waters. The pebble in this case is the inflation war, and the ripples it creates. Those are the market turbulences that Jamie Dimon, head honcho of JPMorgan Chase, warns us about. His words carry weight, not just because of his position, but due to his tenure as the longest-serving CEO of a major investment bank. Let's start with the first ripple, market volatility. It's the financial equivalent of a roller coaster ride, except not nearly as fun. Prices go up, prices go down, and investors' hearts race with every sudden turn. Add to that the liquidity issues in treasuries, where the once steady and reliable bond market could start to feel like quicksand for investors. The pebble keeps sinking, and the ripples spread further. Dimon suggests that the Federal Reserve's battle against inflation might not end with a ceasefire, but with more gunfire, in the form of further interest rate hikes. Now, if you're thinking that this is a case of the more the merrier, think again. Persistent inflation is like a stubborn weed in a garden, not so easy to get rid of, potentially leading to a higher cost of borrowing and impacting economic growth. But the ripples don't stop at the borders of the United States. Remember, this is a global pond we're talking about. Geopolitical tensions, particularly in Ukraine and Israel, add another layer of complexity. These conflicts could act like additional pebbles, causing their own set of ripples and affecting the global economy. As the dominoes of economic events begin to fall, the world braces for potential tremors. But what does this mean for the average Joe? We've covered the macro picture. Now let's bring it home. How does this economic roller coaster affect you and me? Firstly, let's talk about interest rates. If you've ever taken out a mortgage, student loan, or even a credit card, you know that interest rates can be a big deal. When rates go up, so do your payments. For instance, if you're in the market for a new home or looking to refinance, a rise in interest rates could mean tens of thousands of dollars over the life of your loan. It's not just about home buying either. Higher interest rates can make all kinds of borrowing more expensive. Now let's shift gears to inflation, that pesky little word that means your dollar doesn't stretch as far as it used to. When inflation remains stubborn, everyday costs can start to creep up. That loaf of bread, gallon of gas, or even your morning cup of joe could become more expensive. Over time, these increases can take a bite out of your budget, making it harder to save or even to cover your basic expenses. So what can you do in the face of these economic headwinds? The key word here is preparedness. Having a solid financial plan, a healthy emergency fund, and a diversified investment portfolio can help you weather these storms. It's also crucial to keep an eye on economic trends and adjust your strategy as needed. In the end, even though we can't control the economy, we can control how we respond to it. By staying informed and being proactive, we can navigate these uncertain times with confidence. As the world navigates these turbulent economic waters, it's crucial to stay informed and be prepared.